We hope that you are refreshed and excited for our next panel discussion, where we will be discussing the economic and market outlook and how to not only survive but thrive in times of uncertainty. Let's meet our distinguished panelists for this session. First up, we have Shih, Assistant General Manager, Investment Research from Public Mutual Berhad. Next, joining us is Cheng, CEO and Head of Investment at FIMM Asset Management Sdn Berhad. And completing our panel for this session, we have Munirah Khairuddin, CEO and Country Head Malaysia from Principal Asset Management Berhad. And moderating this discussion is Mr. Muhammad Redza Rahman, Head of PNBRI Research Institute. Ladies and gentlemen, please join me in extending them a warm welcome.
We have two distinguished speakers here, and altogether they have more than 80 years of experience, but certainly they are a lot younger than 80. Yeah.
Makes me look old.
I'm the oldest, I got many more white hair. Anyway, the session on market economy and market outlook, a lot has happened this year, and I think we heard from Dr. Khairuddin that the landscape has changed post-pandemic, and there's a paradigm shift. And also, as we look on the market, a lot of things have happened, and we have seen monetary policy tightening in US and Europe that have unfortunately resulted in our ringgit to depreciate because we didn't have much room to go up and shouldn't be going up. But to unpack the situation, we have three distinguished panelists here. But I think for start, let's go on the top from the US. Maybe I can ask Long first, the first question, because the thing is, if you look at what's going on in the future, initially Fed was expected to cut rates towards end of 2023, but it seems that they're not holding on to the rates until 2024. So what's going on here? What's your read on the changing expectation?
Thank you, Redza. Thanks for having me. Well, to start with, you have to look at the 3 years experience of the US economy. So with the pandemic, there was a supply shock, and when the US government put trillions of money into the system to reflate the economy, that caused a demand shock, and that's why the Fed have to raise interest rates. So at 500 basis points increase in rates is one of the highest within a short period of a year, and that has caused fears that the US economy cannot tahan, that US economy will go into recession this year. So even in March, the Federal Reserve did say that a recession is a possibility. But strangely enough, and a lot of economists as well as ourselves were surprised that the US consumer is very resilient. We couldn't understand it. The first half of this year, GDP was 2%. And now the Federal Reserve has shifted their view, saying that the economy will not go into recession this year. Next year is a different story. So the expectations, the market expectations is that the Fed will cut interest rates next year to around 4.75. Currently, the Fed funds rate is 5.5. So the change in expectations is that you have a stronger US economy this year, and that enables the Fed to be higher for longer, meaning interest rates could be higher throughout 2024.
But then again, we have US presidential election coming soon, right? And then Trump says that I'm back. So what's your view over the coming elections? And also, I mean, who's the candidate? Because we're looking at maybe Biden not even strong enough to do his second term, right? So do you think there will be any potential policy shifts in the US?
Yeah, that's a very interesting question because it could be the elephant in the room, the US elections. Donald Trump has already said that he is going to run. He's not been confirmed yet. The confirmation of the candidates from the Republican and Democrats will be sometime in middle of next year. His chances are quite good because he has a lead of about 19 basis points over Biden. The reason I say that is because the Republicans are more pragmatic. They are not so interested in overseas campaigns or ideology. They are more pragmatic, business-oriented, and Americans know that a weak US dollar is good for business because a lot of their earnings come from overseas, Facebook, Amazon, and when you take the earnings back, a weak US dollar means more currency, foreign currency earnings. Yeah.
It might be such way to Google and Facebook. I mean, the thing is, we have seen a lot of retrenchment, right, along the past 1 year, and it's still continuing. Today, we hear another report of retrenchment from the tech companies. So, what's your read, Cheng, in terms of where what's going on now? Because Nasdaq is recovering from the decline in last year, and do you think there's a tech sector will still be the area for us to go for in 2024?
Hey, morning everyone. Thanks, Redza, for your questions. Okay, if you look at the headline figures, right, those are employment figures, job data, non-farm payroll. Basically, US is posted a very resilient figures, but these are headlines. But you look into deep, basically you discover that the service PMI is quite strong. US service PMI is still expanding above 50, whereas the manufacturing PMI is below 50. That signals the contractions. So, in other words, it's telling you that basically the services sector is still hiring people. A lot of job creation, is from the service sectors. So, yeah. So, in fact, of like tech, it's more on manufacturing. Wow, I say, you're talking about whether, the in terms of valuations, all those things, I would say that, this year's the S&P 500, the Nasdaq is mainly driven by all those what you call mega 7 tech, okay, such as Amazon, your Microsoft, Apple, Meta, Alphabet, okay. So they went up so much, you see, especially NVIDIA, we talk about AI hype, all those things. So in terms of if you strip up all those mega 7 tech, mega tech, basically the PE for the S&P for the remaining stock is about 16 times. It's trading at almost like near the mean PE for the 5 years. It's reasonably well, the valuation is okay. So whereas you look at the mega 7 tech cap, basically it's trading at about 27 times PE. It's quite on the high side. So if any external shocks coming in, yeah, most probably these mega 7 tech caps most probably will subject to some corrections. Yeah.
I see. Thank you. But that's a feeling off the ground. But on the ground, right? I mean, Munirah here happens to come back from the US and Europe, so maybe she can share with us what's her take from the ground. What do you see happening?
Yeah, I think, as you know, the global markets have been facing a lot of headwinds, and what my fellow panelists were saying is really quite true. But when you strip it out, the US slowdown is actually not as severe as the market thought, and therefore interest rates remain at this kind of level. And the question is whether interest rates are going to come off or not, and when. I mean, I think that's the $1 million question. But the truth is, while inflation is decelerating, there's still pockets, right? Corporate earnings are still doing quite well. So there's some imbalance in the economy. And I think where the Fed is a bit worried is if they start to slam the brakes, you're going to start to see inflation could resurge, right? I was talking to the van driver, right? And I was talking to the waitress at the hotel that I was staying in. So waitress has got 4 jobs. The van, 4 jobs, because cost of living has gone up. The van driver, he runs a fleet of transport, and he has also catering business. Catering business have dropped significantly because consumers are less disposable income. So signs of economic hardship on the population is there, but inflation is still high. So I think it's a wait and see kind of moment at the moment. But it's very interesting, to your point, right? Actually, it doesn't feel that the American economy is contracting at all, right? It feels, the malls are still there. While retail is mostly online, but actually the shops are still there. So it's very difficult for the Fed to make that call, actually.
See. See, that's interesting. What's your view on Europe? Because since we're doing quite
Yeah.
okay, right, taming the inflation.
Actually, Germany is undervalued. I went on a roadshow with our global fund managers, to meet some of our clients, and the interesting thing is, international fund managers do have exposure in Asia via European companies and global companies. And this kind of shook me a little, because while we are, plagued by China not coming out of this situation, actually, global investors are still investing in Asia via European, UK, and US stocks because of the multinational nature of their companies with exposures in China and the rest of Asia. And think about it this way, right, that they find the risk premiums in investing in those markets, in those European and UK names and US names, are less than the risk premium of investing directly in APAC ex-China. So the flip side to it is, while we are not seeing the uptick in Asian equities, but actually there's still exposure, there's high exposure to this point, right, on people, the Amazon, Meta, and all the earnings are coming from Asian markets. So it's a balanced world, actually.
So do you think that Europe will be the area that we should be excited about in 2020?
Actually, it's hard to be excited about Europe, right, because of how they are, stagnation and all that. But there are pockets, so Germany, as I mentioned, we find them undervalued. But we also see, because we're stock pickers, there are certain companies, as I mentioned, with those international exposures that have quite interesting, entry levels.
I see. Long, what's your view on the ECB monetary policy moving forward?
The good news for the ECB is that the inflation in Europe, the Eurozone, has actually come down. It's gone down significantly, in fact, in the month of September to, I think, 4.3%. It was as high as 9% last year. So that actually improves the real income of the European consumers. And that is why, with this decline in inflation coming down even next year, there could be some improvement in the Eurozone economy. But having said that, if you look at the historical growth of Eurozone, it's about 1%, 1 to 1.5. So we don't think that it's a very exciting economy, but there could be some trading situations, as Munirah mentioned. Germany looks quite interesting because wages are rising also. That's the thing. What I heard from some European economists is that wages in Eurozone are rising. So that is a positive impact on consumers.
I see. So what are your thoughts about the still ongoing Ukraine-Russia war, right? So is it like a norm already, or do you think it's coming to an end anytime soon?
Yeah, that's a tough one. Basically, geopolitics is really unpredictable, but from what I can see is that the Ukraine-Russia war has not been settled, partly because of the resistance from NATO, mainly the US, and perhaps some countries in the Eurozone. Hopefully, there could be a solution. The problem with Europe now is that when Merkel was around, she was recognized as a leader in Europe. Everyone listens to Merkel, Angela Merkel. And now the leadership in Eurozone policy in terms of geopolitics is like, passed to the Americans. Yeah.
See, you want to add anything, Munirah?
No. Oh. I was just talking about tech stocks, right? I mean, it's interesting. We were talking about food security, right? And you would think food security. Talk about ESG. I know I'm kind of ahead of you right now. We talk about food security. I was talking to my analyst, right? And you would imagine, these are companies with, farm production, plantation, etc. But food security today is actually about producers of enzymes, right? So areas like biotech, and tech, right, when you think about it, has a long runway to go. So to your point that tech valuations are high, yes, it is high, but I feel that we are now unpeeling the onion in like maybe mid-cap and small-cap, the new names that are coming out in technology. So who would have known, right, when you talk about food security, is the enzyme companies that has got interesting runway, right? Yeah, I don't know why that came to my mind, but really it's a world of, while we talk about macros a lot, there's still a lot of potential in many companies out there for us fund managers to invest in. So while it sounds all depressing, I think you got to leave it to the fund managers, right? There's really many interesting pockets of names that still upcoming.
That's an interesting point, because tech is not just about semicon, it's not just about EV. There's so other lot of things that is relevant to tech. Tech disrupt all sectors. I'm sure there are things that are interesting that's coming up, but just bear in mind that, read the news, read the mega trends, and I'm sure there are things that...
Like this enzyme, right? I mean, why we're into this food security, we like the angle of this enzyme, because, if your bread has a 3 days shelf life, right? With the advancement of technology, you're talking about bread having 2 weeks, days of shelf life. So, technology like this is up and coming, and you're right, it's not just about EVs and stuff, right? I think we need to broaden the horizon a little bit more.
True, right? Ladies and gentlemen, I think we've talked a bit about developed economies, but maybe we can break it down to Asia. But I think certainly one thing that stuck out in my mind is Japan. Macro is not doing that well. Aging society, yet is one of the great performing market this year. So what's going on? Maybe Long can help to answer that.
Yeah, Japan is a real surprise this year to a lot of fund managers. But basically, it boils down to the mindset of the regulators, especially the Tokyo Stock Exchange regulators, as well as the consumers and corporates. So there is a shift in mindset from deflationary mindset to inflation. So Japan in the last 2 years, during the COVID crisis, has never seen inflation gone up to above 5%. And when they feel that inflation, it's like a shock to their system, and they have managed to ask their employers for higher wages. So wage growth in Japan for the last decades has been like 0.5%. But this time around, because of inflation, it encourages the workers to demand wage increase of 3 to 4%. So imagine, if you have 3 to 4% inflation, and this year's Japan inflation is around 3, it's zero real return, right? Real wages. But next year, inflation is going to go down to 2. So as your inflation comes down, your real wage of 3 to 4% is actually quite good for purchasing power. So that's one aspect. And then the other aspect is that the Tokyo Stock Exchange regulators, they are emphasizing on corporate governance. They are asking companies, especially those with price-to-book ratio below 1, to emphasize on returns to shareholders. And that means either if you have excess cash, invest in your company or return it in terms of cash buybacks. And that's why the Japan market hit, I think, a 33-year high this year.
Interesting. But before I forgot, if you have any question, please scan through the QR code and send over the questions to us. We'll try to answer as best as we could. Anyway, just to, the thing is, Japan is one thing. What about China? Munirah, what's your view on China? It's still growing. Yeah, it's turning a big, and certainly there's a lot of opportunities in China. So what's your take on China, maybe not in the next couple of years?
Yeah, this is an interesting question. So principle, we have a joint venture with China Construction Bank in China. And so we were asking them, right, like how long, man, how much longer? And their answer was actually quite methodical. They said, this is a 1.4 billion economy, people, And it takes time to clean up, and it takes time to ensure that, you know, there's no more credit blow-ups, property blow-up, etc. And it feels as if they are doing it very, very measured. And of course, we are losing patience, right? But when you think about it, you know, they're quite convinced that by second half next year, we'll be sorted. So I was like, oh, maybe you guys are buyers, right? But having said that, you know, when you think about it, it is, and we talk about, oh, should we go Asia x China? Should we go, you know, China +1? The truth is, you cannot not invest in China. Yep. It has come to that so large of a market cap that you cannot not invest in China. And there's still very, very good names, whether it's mid-cap, right? Some of those big caps, yes, they've got a lot to sort out, but the mid-caps, especially in technology, etc., it's like so ahead. So I think it's a matter of time, and we're still investing in China. And to my point, right, just now earlier, European, UK, global investors are investing into Asia, but via their companies. So it gives some comfort that, you know, people are still invested in the economy of China. They may not be investing directly in China companies, but I think sometime next year, I hope China will turn around. Innovate them.
Cheng, you have any things to add?
Yeah, I think basically Chinese government, they are trying to let the market mechanism to solve the imbalance of the residential markets, their property issues. So yeah, that's why you see a lot of negative headline coming out, you know, for the real estate sectors. But yeah, in the short terms, it looks like challenging, but over the longer term, yeah, like what Puan said, right? I think China is still a second major largest economy in the world. You can't ignore the Chinese economy, the contribution to the global economy. Yeah, so in fact, in terms of those technology, they are catching up very fast. You look at Huawei, you know, the way they come out with the latest phone, you know, the AI technology, you know, the chips, and also the 5G things, you know. All the transitions from the technical changes will come very, very fast in China. So even we talk about China +1, again, you must bear in mind that, you know, you can't totally ignore China, you know, the efficiency, the way they do things, you know, the way they work, yeah.
Arguably, I think if investors have the patience, right, to ride through it, because there's always opportunities in this kind of market dislocation.
Yeah, and also just talking about market dislocation, I mean, there's a concern over China's going after property firms that have huge debts. Should this situation be taken positively in terms of trying to acquire stocks that are cheap by valuation because of the fear? No.
Are you referring to the sovereign funds buying?
Oh, and also the rundown over the government hovering over the property companies that have a lot of debts.
Yeah, I think from the macro point of view, the reason foreign investors are not so keen on China is because in the last 2-3 years, you can see that there's more regulation, more control. But they have started to relax it, especially with the COVID policy. That was a major surprise for us. We thought that China will still maintain zero COVID. So when they opened up the economy, that was like a huge open door for investors to relook at China. Mm-hmm. But as you say, the regulatory control is still there, right? And the Xi Jinping's policy is the priority of the country is security rather than corporate profits and wealth. He has to deal with the income gap too. So that's why China is rather a slow-moving economy in terms of the reforms. But as the panelists say, you can't really ignore it. Yep. Because eventually, if let's say China were to grow at 4%, 3 to 4%, and Japan grows at, let's say, 1 to 2%, both are major economies in Asia. So if China becomes the next Japan, you have two Japans anchoring the economies of Asia. So nothing to shout about. It's not going to be like Indonesia growing at 5% or India growing at 6-7%. But it's sort of anchor your growth for the
The
region.
sheer size itself is already dominating the
Yes,
world, right?
yes.
And it's something that we cannot ignore.
Yes.
What about your thoughts? Any thoughts on India, Munirah?
India is not an easy market to invest, to be honest. But you know, there's potential growth. Obviously, there's growth, and the sheer size of the population and the domestic economy, I think, backs them up. However, you need to be quite careful and really select the right kind of stocks and sectors, lah. That's our view on
I see,
India.
right. I mean, let's, we have 15 minutes left, so I think let's bring back to Malaysia. So maybe I would like to seek thoughts in terms of what's your view on budget. Maybe start with Long first.
Yeah, I think the budget was for 2024 is actually quite encouraging because for the first time you can see that the government, the Ministry of Finance, is reducing the subsidies. The total subsidies is expected to reduce by 11 billion ringgit due to removal of the chicken and egg ceilings and restructuring of the diesel. So it is very encouraging that you can see that the deficit to GDP is falling from 5 to 4.3. But having said that, we observed that there was one item in the this year's budget which is quite huge. That was about 13 billion, and that was for the repayment of the 1MDB bonds. It's a redemption. So if you take away the 13 billion from this year's budget, actually Malaysia has already achieved 4.3. So we have actually achieved 4.3, which is supposed to be next year's target. So I think it is encouraging. Over time, hopefully we can reach the 3% level in the next few years.
I see. So, Munirah, do you think Malaysia on the right track to have do a good job in terms of managing our fiscal?
I have to be politically correct. This is a FIMM's conference. I'm kidding. I'm kidding. As Long was saying, right, it is encouraging. It is encouraging, and I think we are managing our fiscal deficit in the right way. But I cannot help but feel we could be more aggressive. And I think the second one is on the National Energy Transformation Plan. There's a lot of devil in the details. So I think it's really important that that companies really shape up because our stock market is actually very, very narrow. So, and we talk a lot about, wanting to go to net zero, etc. I think there's not enough resolve. There's a lot going on. Just make sure that we're not greenwashing. There has to be a lot more resolve in the execution plan. So I think we're waiting whether this is a sustainable national energy transformation plan. We need to show that. And thirdly, I'm really waiting for exciting IPOs. The most exciting IPOs last year was Farm Fresh and Mr. DIY. So really, we need to have more exciting IPOs with tech names, with future names, innovation names, because it's really hard to now compete with our neighboring countries, right?
True.
It's very, very hard.
And then also with the new industrial master plan and ATR, right? So it's still far away, but I think we are doing okay, but we need to accelerate the way.
Yeah, I was talking to some people, right? And one of the ways is that we really need to encourage more VCs, more, that kind of sandbox, because, we're really far behind. I mean, our IPOs are not exactly very exciting.
And then yesterday also I heard during the session with Tunku Zafar, which I mentioned that labour productivity also is quite bad, right? In Malaysia, we are falling behind even our peers in ASEAN. So anyway, we are way to Cheng. So any positive things that, any excitement that you see from either NIMP or the NATR?
Well, if you look at the newly announced new industrial master plans, basically, as you all know, that the plan is trying to enhance our manufacturing activities to high-value activities and hence create more high-value jobs. of course, it will increase the pay of the rakyat. So in this case, I think, as mentioned in the budget also, yeah, so basically there will be a tax incentive allowance on those qualified capex on these high value added activities, in the sense like, in the likes of like, your renewable energy, your EV, your advanced E&E, your advanced material, pharmaceutical, and also those aerospace technologies. So these are the efforts that taken by the government trying to incentivize the private sectors to embark on those automations and then try to enhance the value chain of the whole manufacturing activities in Malaysia.
I see, but yet again, we are still pretty much dependent on commodities, right? I mean, the recent tension in Middle East has certainly caused a lot of spike in terms of oil price, and in the budget we have an estimate of $85 per barrel. Do you think that level is sustainable, or in moving forward, or whether there will be a prolonged increase in prices, considering that there's no ending? I mean, even for the Russia-Ukraine still going on, right? So, any thoughts on that?
Wow, these are tough questions. As you look at the crude oil prices, basically it's yo-yo, you see. Every day it's up and down, you see. Yeah, if you look at the crude oil prices right now, there's a new factors come into pictures. As you all know that currently the consumption, the demand for crude oil is about 50% contributed by transportation. Okay, so with the rising of populations, with the rising of the EV trend, everyone's driving EV. What will happen to the fossil fuel? So these are the new parameters coming into equations right now, and of course on the demand side also, everyone talk about China. What happened to China? Is whether there will be a severe economic slowing down for next year. So on the demand side, we have these two key factors to determine whether how the crude oil prices react. On the supply side, of course, we look at the geopolitical risks. If you talk about supply of the crude oil prices, of course, you have to talk about OPEC plus, the Russia, the Saudi, especially with this kind of Gaza crisis coming in, what will happen? Okay, so looks like there's a tussle between the demand and the supply. Okay, so it's quite difficult to predict the crude oil prices, but I believe the government projections of 85 per barrel is quite realistic. Okay, it's quite practical. But of course, I don't think the crude oil prices will go back to the pre-pandemic level of 50 to 60s. Okay.
All right. So before we open the question to the floor, just one question to Long. What's your view on ringgit? What's your view on ringgit?
Oh, the ringgit. Well, that's a tough one. We, in our research department, I got some of our analysts to come up with a model. So we came up with a 4-factor model on the ringgit, valuations of the ringgit versus US dollar. So it doesn't seem to work that effectively in the last few years because even with high oil prices, the ringgit doesn't appreciate. So historically, the ringgit appreciates with high oil prices. Hopefully that historical relationship will resume next year, because if we are looking at $85 US, it should be positive versus $80 this year. So that provides some upside on the ringgit.
So what's your magic number?
Oh, well, I'd rather quote the Bloomberg consensus, which is surprisingly 440 by end of next year. And by this end of this year, 465.
Yeah. Thank you. Good. Let's open the question from the attendees. Anything that we have on Slido? Okay. Okay. Question number 1: are there any emerging markets or region that you believe offer significant growth opportunities or pose unique challenges? Maybe I'll address that to Munirah first.
I think Asia EM is still attractive because we understand this region well. And within that Asia EM, you need to look at ASEAN, I think. Right? It's a long shot, but people always say, oh, ASEAN's got so much potential, yet it's not sustainable. But actually, our ASEAN funds have done really well. And it's a combination of stories, right? And picking the right stocks in Indonesia, in Vietnam, Malaysia. So there is opportunity still in this part of the world. The unique challenge would be we have, non-stop elections. It's like a rotation, one country to another, that could impact policies. But I think when China recovers, you would see ASEAN recovering even a lot better. Even year to date, ASEAN has done quite well, actually. So I still believe in our region.
Gung-ho for ASEAN. Second question, some countries are moving away from USD as their trading currency. How will this impact the global economy and market? Maybe Long can answer that. Even Malaysia also, we have, with China, right? We are trading it in ringgit. So,
Yeah, we actually looked at the US dollar and this trend called de-dollarization. We have a lot of unit trust agents asking about the trend of de-dollarization. And after looking at the entire, researching the topic, it looks like the dollar is still a very vibrant and strong currency because there is no substitute for the dollar. When you look at other currencies, whether it's the euro, the renminbi, they are not used widely. And one of the reasons is that the US has a very healthy bond market, the treasury bond market. That's where people can put their money in the US treasuries. Like, for example, China, the bond market is not fully developed, right? So where do you put your money if you have excess renminbi? Okay, so regarding this, countries are moving from USD. There is some trend because 60% of global central bank reserves is in US dollars. But if you look at it, 20 years ago, it was 70. So there is a slight trend of coming down in terms of usage because the fact that the US used the US dollar to sanction Russia. So now there is a geopolitical fear that, in future, what if China gets sanctioned? The Chinese central bank are holding a lot of US dollars, so they do not want to hold so much of that. They are, like the BRIC nations, encouraging them to move away. But so far, there is no alternative to the US dollar. But having said that, the interesting thing is that if interest rates next year are peaking and interest rates are coming down, that could cause the US dollar to weaken. So there could be some form of hedging for that trend.
Maybe I'll just, before I take that question, just answer a bit to sideways a bit, move to Munirah, because I think it seems like interest rates has been quite volatile, and then is fixed income an interesting area to look at moving forward? Should we have more fixed income funds?
Fixed income is interesting. I was a fixed income manager, so I'm biased. But having said that, there's now income in fixed income, right? Those high yields have allowed investors to really enjoy income in fixed income because of the high yields. So I think it will continue to be an interesting asset class next year. In fact, our house view is we've moved fixed income neutral, equities neutral, even alternatives as neutral. From, equities was negative to now neutral. All are on a neutral stance because we are at that cusp of, markets, whether Fed is going to pause or not. And you find that, it's a turning point for many asset classes. Even for global REITs, right? Usually global REITs tend to rally at the peak of interest rates because, once after that it goes down and then REITs go up. So there are many still interesting pocket of investments, and yes, fixed income I think is still here to stay.
Good, thank you. I'm going to save the second question to last because that's the question I already have we'll be asking the panelists. So maybe Cheng, you want to take the, we combine the two questions. First one is on the impact on the global stock market from the Middle East tension, and also the emerging of Saudi Arabia reform. So what are your thoughts about the developments in the Middle East?
Okay, basically I'm not an expert on Saudi, okay. All right, if you look at the Saudi, right, the first thing they do is actually, they are trying to talk to China, all the, the crude oil trading is used renminbi. So if you recall that why, people call petrodollar is mainly because oil is, heavily traded. So if you're using US dollar, it's more liquid and everyone needs US dollar. So in this sense, I think we started to see that Saudi is switching from US dollar to diversify into using renminbi to trade, crude oil prices. So you see that, with the young prince there, he's trying to diversify his risk and also opportunity to China. So we can see that, with, most probably he want to exchange something like technological ideas or, skills with China, and they don't want to be so reliant on the crude oil, their commodity. Yeah. So moving forward, I think Saudi also want to develop their biotech, all those things. So I think that it's a good idea that you look at Middle East in a new perspective for the next few years. Yeah, it's no longer a commodity country, that kind of things. Yeah.
If I can add, right, I think we covered the Middle East quite a bit. It's a great source of capital, and I'm not sure there'll be a global stock market because there's still a lot of capital markets development that's needed in the Middle East, in Saudi or even in the UAE. But it's a major source of capital and will continue to do so.
Thank you. I think we are being prompted that we are running out of time, but just to ensure that I don't forget the second question, right, on the opportunities for the next 3 to 5 years, let me modify the question a bit to ask each of the panelists as a conclusion, what are your top 3 themes that will impact macro and markets in the current and medium term? Top 3 themes that will have an impact on markets and in the next 1 or 2 to 3 years.
Okay, in terms of macro themes, from Public Mutual's perspective, we have a lot of funds, and our fund managers all have their own diverse views. But on and off, I do discuss with them their views. And it looks like for next year, one of the macro theme is the peaking of interest rates and disinflation. Now, disinflation means that inflation will be coming down. We don't know when. It could be in the second half. And if that is the case, then the Federal Reserve will cut interest rates perhaps all the way down to 4.5%. That is very positive for equities and also for bonds. So it is also positive for currencies, because if interest rates in US is coming down, you could see a 5% average increase in emerging currencies. And that is actually very positive for investors. The second theme would be basically the theme of technology and growth. I think this basically high interest rate environment has distorted a lot of valuations in companies. And when the interest rates stabilize to a more normal level, then you could see more fair valuations for certain companies, perhaps in technology, in EVs, yeah. And the beneficiaries of the China Plus One strategy is we can see that it is like Japan, South Korea, and Taiwan. So those are countries that could also ride on the semiconductor recovery. So that's it.
Cheng?
Yeah.
Quickly, we are running out of time.
Yeah, I would say that 3 things to watch out for remaining this year and next year would be, first one most probably would be the geopolitical risk. I think the market has not fully priced in the risk, especially talk about the war, in Ukraine, Russia, and also the Gaza crisis. And next year most probably there will be Taiwan elections, right? So these kind of things, on and off, will spoke the market sentiments. So I would say, geopolitical risk is the first one. Second one would be more on the macro side, more on the U.S. Whether the key question is U.S. will face some stagflation issue with high inflations that cannot get back to the 2% Fed target, and also what if the economics start to slow down substantially. And of course, the China also we need to watch out. What happened to China? Okay, the economy, everything. Yeah. So the last would be most probably I would see some positive side, rising opportunity in ASEAN, especially we talk about the China plus one things coming out. I think those are MNC, they're learning from their past experience during the pandemic lockdown in China. So I think there's the trend that their intention for them to diversify from China. Okay, so yeah, most probably, look at ASEAN with the very strategic location, relatively, lower labor costs, and also like Malaysia, Indonesia, we have a very good infra. I think most probably we can attract FDI into Malaysia, especially the ASEAN. Yeah.
Thank you.
Very quick. Okay, yield and income. Alternatives, which is private assets, real estate, direct lending, infrastructure. Third theme will be if equities, US, mid-cap, ASEAN, and pockets of tech.
Right, thank you. I think in conclusion, we've seen that there are still challenges in macro and also market, yet there are still pockets of opportunities that we can take advantage of. And certainly, what the panel want to project is that not all things are bad, but be able to find opportunities elsewhere where we can find opportunities to find like what family would like to say, find the alpha, right? Right, thank you, panelists. Ladies and gentlemen, please give a round of applause to these three panel experts, hope what we've discussed been very beneficial to everyone. Thank you.